How to Trade with Price Action, Kickstarter, by Galen Woods 2014. Introduction. This ebook contains a selection of articles I have written on trading setups review. You can find out more about me by clicking here. All articles in this ebook are available for viewing online at http://www.tradingsetupsreview.com for free. In this Kickstarter edition, I have carefully picked 10 articles and guides that are especially useful for traders new to price action trading. It covers an introduction to price action, common price patterns, and basic trading tools. I hope you find this ebook a friendly companion for your offline learning, and I wish you all the best in your trading career. 1. Price Action Trading Primer. 1.1 Definition of Price Action Trading. Price action trading is the process of observing market price movement to anticipate future price movement. The purpose is to transact in the market to make a profit. As it uses past and current price action to predict market movement, it is a branch of technical analysis. Traditional technical analysis focuses on chart patterns like double top, bottom, head and shoulders, and flags. However, price action trading is increasingly used as an umbrella term that includes analyzing chart patterns, bar patterns, and candlestick patterns. Look at how search volume in price action trading has increased steadily while searches of chart patterns has fallen. In its current context, price action trading focuses more on short-term bar patterns and candlestick patterns. Some examples include pin bar, inside bar, engulfing candlestick, harami candlestick. Price action trading is often contrasted with indicator trading, which uses mathematically derived formulas to produce trading signals. Pure price action trading excludes the use of any trading indicator. However, price action analysis and trading indicators are not mutually exclusive. In fact, many price action trading strategies include indicators as a complement. 1.2. Origin of Price Action Trading. Dow Theory. Price action trading shares the same roots as technical analysis, which comes from the Dow theory. The theory offers to explain market behavior and focuses on market trends. One of the tenets of the Dow theory is that the market price discounts everything. Price is the cumulative result of all market information. Hence, technical analysts use price charts and chart patterns in their market study. Learn more about technical analysis of trends and chart patterns with the following books: Technical Analysis of Stock Trends, 10th edition, Robert D. Edwards, John McGee, and W. H. C. Bossetti. Encyclopedia of Chart Patterns, Wiley Trading, Thomas Bulkowski. Bar, Candlestick Patterns. In line with the study of price, short-term bar patterns like inside bar, NR7, and key reversals emerged. After Steve Nissen introduced Japanese candlestick patterns to the Western world, such short-term price patterns experienced a renaissance. Since then, candlesticks have become the most popular chart type for price action analysis. The upper and low shadows, or wick, of a candlestick show selling and buying pressure respectively. The candle body represents the resulting market sentiment. If the bar closes higher than it opened, it is bullish. If not, it is bearish. However, if the close is near to the open, the sentiment is unclear. Such a candlestick is known as a doji. The entire range, distance between high and low, signifies volatility. Learn how to read price action bar by bar. Refer to these books to find out more about bar patterns and candlestick patterns. Japanese Candlestick Charting Techniques, 2nd edition, Steve Nissen. Pring on Price Patterns, The Definitive Guide to Price Pattern Analysis and Interpretation, Martin Pring. Bar by bar analysis. Subsequently, traders started pushing the Dow principle of price discounts everything to its extreme and started studying price action bar by bar. The observations of tape readers and floor traders on market movements also contributed to current price action trading techniques. The summation of chart patterns, bar, candlestick patterns, and other market price tendencies then led to price action trading as a distinct topic. While price action trading is widely discussed in online trading forums and trading courses, very few publications have attempted to organize its body of knowledge. Nonetheless, Al Brooks's 3-book series on price action trading has accomplished this. 1.3 Markets for Price Action Trading. Price action analysis work in most actively traded markets, as long as reliable price data is available. Generally, price action traders favor the forex, futures, and stock markets. A significant proportion of price action traders are active in the forex markets. 1.4. Essential price action trading concepts. Price patterns. There are dozens of bar patterns and candlestick patterns. Given the right market context, these patterns offer trading opportunities and are known as trading setups. These are some popular price action patterns: Hikaki, engulfing candlestick, inside bar, NR7, pin bar, market swings. Market prices move in swings. Price action trading interprets higher highs and higher lows as an uptrend, and lower highs and lower lows as a downtrend. A notable theory on the behavior of market swings is the Elliott wave theory. It postulates an 8-wave pattern as a fractal of market movement. Frost and Precher's Elliott wave principle, Key to Market Behavior, offers in-depth information on this theory. For a price action trading strategy that demonstrates how to trade an engulfing candlestick pattern with the support of swing highs and lows, click here. Support and resistance. Price action traders also project support and resistance levels using swing pivot points. Support areas are likely to reject price upwards, and resistance areas tend to prevent the market from rising above it. Support and resistance are core price action trading concepts. The key to successful price action trading lies in finding effective support and resistance areas. Learn. Improve your trading with support, resistance. Trend lines and channels. Trend lines connect swing pivots to track trend and serve as support and resistance. In a bull trend, trend lines are drawn by connecting pivot lows. In a bear trend, trend lines are drawn with pivot highs. By extending a parallel line from the trend line, we can form a trading channel that is useful for anticipating support and resistance areas. Learn how to trade a channel. 1.5 Price action trading methods. Most price action trading strategies make use of price patterns together with support and resistance areas. The standard approach involves looking for a bullish price pattern at a support area for a long trade, or a bearish price pattern at a resistance area for a short trade. Pure price action. Some traders use price action analysis exclusively. They adopt a minimalist approach and do not place any indicators on their charts. These traders are well versed in spotting price patterns and support, resistance areas. Price action with volume. Another tenet of the Dow theory is that volume should increase in the direction of the trend and decrease when moving against it. Hence, it is not surprising that volume analysis is a common addition to price action trading. Classical volume analysis combines volume patterns with chart patterns to evaluate the trading opportunity. Combining volume with price action has also led to the development of volume spread analysis, which is based on Richard Wyckoff's work on relationship between volume and the spread range of the bar. Price action with indicators. Despite the emphasis on price analysis, many price action traders still find value in indicators. The most popular trading indicator among price action traders is the moving average. It serves as a trend indicator and a dynamic support resistance at the same time. An example is Al Brooks' trading approach that uses a 20-period exponential moving average. In Steve Nissen's books on candlesticks, he also included chapters on analyzing candlestick patterns with the help of trading indicators. 1.6 Beyond the Primer. To learn more about price action trading, head over to our price action section, where you will find price action trading strategies and tips. Whip out your charts now and start paying more attention to price, the most important variable. 2. Beginner's Guide to Reading Price Action. Reading price action means knowing what the market has done and what it is doing now. Armed with this knowledge, we increase our chances of predicting what the market will do. If you have no idea what price action is, take a quick look at our price action trading primer. We'll wait here for you. Most traders learn how to read price action by learning bar patterns and candlestick patterns. The problem with this approach is that we fixate on names and labels and interpret them mechanically. As a result, we miss the rich details that reading price action adds to our market analysis. Hence, in this guide, we will introduce price bars and price action patterns in a microscopic way. This will ingrain in you the skill of reading price action, instead of repeating a bunch of fancy nomenclature. 2.1. 1 price bar. A price bar is a visual representation of price data in a given unit of time. Common time units include 5-minute, 30-minute, 1 hour, daily, and weekly. In this guide on reading price action, we are using a particular type of price bar called candlesticks. And we will refer to bars and candlesticks interchangeably. We need 4 pieces of information to draw a price bar. 1. Open, O. 2. High, H. 3. Low, L. 4. Close, C. Plotting price bars with these basic price data, OHLC, is a simple affair. Just remember that when a bar closes higher than it opened, we color the difference green. If it closes below its opening price, we color it red. This distinctive colored body is the only difference between a traditional price bar and a candlestick. These candlesticks are more than just pretty summaries of OHLC. Once completed, the price bar gives us another 4 pieces of information that are critical for reading price action. 1. Range. 2. Body. 3. Upper tail, wick, shadow. 4. Lower tail, wick, shadow. Range. The range refers to the extent of the market's journey within the time unit we examining. It shows us how volatile the market is. Dead markets move little and cover less ground per unit time. Active markets move around more. By observing the range of a bar, we are able to assess how volatile the market is. Is the market sleeping or running amok? The bar range will tell you. Body. The bar range shows us where the market has battled. Its body shows us where the market has conquered. It indicates the strength of the bar. The strength is either bullish or bearish. If the bar closes above its open, regardless of what happened in between, the market has moved up. The bar is bullish. The opposite is true for bars closing below its open. Furthermore, the size of the body demonstrates the size of the market strength. The diagram below shows the extremes. The candlestick body on the left takes up the entire bar. This is the strongest form of an upwards thrust in the market. The candlestick on the right, however, does not even show a body. The market is undecided. In candlestick jargon, the former is a marubozu and the latter is a doji. However, we are not talking about labels today, and the names are not important. What is important is that we are able to answer these questions by observing the candle body. Has the market moved up or down? How strong was the move? Upper shadow. Once you understand what the range and the body of each bar signify, we are able to appreciate what the upper shadow implies. The upper shadow represents the area where the market rose to as part of its range, but was unable to conquer as part of its body. It was unable to conquer that area because the market met eager sellers who were more aggressive than the buyers in the market. Hence, the upper shadow measures selling pressure. The longer the shadow, the more selling pressure the bar exhibits. Lower shadow. Apply the same logic to the lower shadow, and you will find the buying pressure of each bar. The longer the lower shadow, the strong the buying pressure. 2 price bars. As we expand our vision to 2 bars, we are able to introduce 2 cornerstones in reading price action: context and testing. Price action context. In trading, nothing works in isolation. The context is of utmost importance. The same goes for reading price action. With 2 price bars, we gain a context for the second bar. The first bar provides a benchmark to aid us in reading price action. We know that the range, body, and shadows of a candlestick discloses useful information. For instance, a wide range bar points to high volatility. But how wide is wide? That is a difficult question. Using the preceding price bar, we can propose a decent answer. At least, we can highlight bars with a wider range. Wider when we compare it with the preceding bar. Now, we are more descriptive when we talk about the price action. From the chart above, we picked random 2-bar combinations to explain what the market was doing in the context of the first bar. 1. The market was getting less volatile with decreasing bar range. 2. Selling pressure increased as the upper shadows lengthened. 3. The market got increasingly volatile as it reversed down. Testing price levels. The concept of testing refers to the market moving towards a price level to test if the price level will reject the market's advances. The high and low of each price bar are natural support and resistance levels. The test of these levels show the undercurrents of the market and is critical for reading price action. This is the same chart as the previous one. But here, we focused on the testing of bar highs, lows to see what it tells us about the market. 1. The second bar rose above the high of the first bar but was rejected. Bearish. 2. The second bar punched below the low of the first bar and continued to become a strong bearish bar. Bearish. 3. After falling below the first bar, the second bar reversed up and closed higher. Bullish. 2-bar combinations allows us to see the context of each bar and brings a lot more depth into our price action analysis. 2.2. 3 price bars. With a clear read of 2-bar price action, we are able to form expectations of the market. We would expect the market to move in a certain way in the third bar. The confirmation or failure of our expectations reveals more about the market and add to our price action analysis. To form expectations, we need to make a very simple assumption about how the market should behave. Essentially, the market has inertia. Bullishness should follow bullishness, and bearishness should follow bearishness. When it does not, we have to consider a possible change in market direction. Remember that we are only looking at 3 bars here. It means that we are referring to very short-term expectations and consequences. We chose random 3-bar combinations from this chart. With the first 2 bars, we form either bullish or bearish expectations. Then, the third bar revealed if the market met our expectation. 1. The first 2 bars moved down with good strength, body size. Furthermore, the second bar fell below the low of the first bar without much resistance. Hence, we expected that the third bar to turn out bearish. Indeed, the third bar tried rising above the high of the previous bar, but failed. 2. The first 2 bars were the exact opposite of the first example. They led us to form bullish expectations. However, the third bar was rejected by the high of the preceding bar and showed increasing selling pressure. A bearish setup. 3. The second bar was bearish regardless of how we looked at it. Hence, we expected the market to fall further. Instead, the third bar was bullish. This failure of our bearish expectations point north. 2.3. Reading price action. Our 3-bar analysis process brought us through the essential concepts of reading price action. Once you grow comfortable with reading price action with this generic approach, you have no need for names and labels, except for ease of communication with other traders. To prove the practical value of the skills you have picked up in this guide, let's take a look at the 2 examples below. Morning star pattern. This chart bottomed out with a morning star pattern. What is a morning star pattern? Doesn't matter. 1. Long lower shadow implied buying pressure. 2. Volatility decreased with some selling pressure. While these 2 bars were not clearly directional, our bet went with the bears due to the long upper tail. 3. However, instead of falling, the market rose up strongly. This failure of bearish expectations presented a bullish setup. This 3-bar pattern is what candlestick traders call a morning star. Pin bar. This chart shows the popular pin bar pattern. 1. The first bar was a nice bullish bar. 2. The second bar was a strong bearish bar that fell below the preceding bar with increasing volatility. Naturally, we expected the next bar to unfold in a bearish way. 3. However, after testing the low of the second bar, buying pressure asserted itself and prevented the market from falling more. This unexpected bullish turn presented a bullish setup. Pin bar. 2.4. A rose by any other name would smell as sweet. An unlikely Shakespearean source summarized a key idea for reading price action. Reading price action is not about finding pin bars, outside bars, engulfing patterns, or any other names. It is about observing price bars as they form and understanding what the market has done and is doing. Once you master the skill of reading price action, you can pinpoint setups without relying on dozens of labels. However, reading price action is not enough for trading price action. It is a critical first step that many beginners overlook, but it is not complete. The next step is to combine short-term price action with long-term support and resistance, and market structure. Proceed and conquer. Trading with support and resistance. Trading with price channels. Trading with market structure. 3. A beginner's guide to day trading futures using price action. Want to start day trading futures? Want a reliable trading method without forking out thousands of dollars for glittery indicators? Follow this guide for step-by-step instructions to get started with day trading futures using price action. 3.1. Choose the futures contract you want to day trade. The first step to day trading futures using price action is to select the future contract you want to trade. A futures contract fit for day trading must fulfill two criteria. It should be volatile, as market movements are the source of our trading profits. A dead market does not offer much room for day traders to profit. It should also be liquid. In illiquid markets, the slippage in the bid-ask spread will increase our trading costs. An intraday trader looking to capture small profits must minimize these costs. Earlier, we analyzed a basket of futures contracts by studying their volatility and liquidity. Beyond volatility and liquidity, you should also consider your available time. While many futures markets trade round the clock, they are active during certain time of the day. Look for markets that are active during the period you are free to sit in front of your trading terminal. Each futures contract has its peculiarities. For instance, each market has a typical volatility pattern throughout a session. Also, the news events that affect each futures market vary. You will need time to research and understand your choice of futures contract. Do not be too quick to switch from one to another. If you are looking to trade more than one market, familiarize yourself with one before moving to the next. As a beginner, it is best to keep things simple and start with one futures market. 3.2. Get your trading platform and data feed. With your preferred futures contract in mind, look for a charting platform and data feed. Many futures brokers offer an array of charting, trading platforms, and data feed packages. Contact a broker and ask for a demo account. You can get a 30-day trial easily. You might be wondering how to choose among the different brokers. You might be comparing their trading commissions and reliability. Do not be overly concerned with your choice of broker at this stage, because you won't be trading live anytime soon. You can spend more time figuring out your broker options when you are ready to trade live. For now, we just want a charting platform with a data feed for the futures contract we want to trade. As we intend to day trade futures using price action, we have no need for fancy indicators. Hence, most charting platforms are enough. No idea which platform to use? I use NinjaTrader. If you decide to start with NinjaTrader, I will be able to help you with setting it up. Just email me. NinjaTrader also offers excellent support through its forum. You can get a list of brokers that work with NinjaTrader here. You can also read this article and use these indicators. 3.3. Learn how to trade with price action. Day trading futures using price action is the simplest way to trade, but it is still possible to go overboard with it. Some traders overload their charts with trading indicators and analyze too much. Similarly, some traders see price patterns everywhere and want to trade everything they see. You must avoid that. Otherwise, you will overtrade. This is a recipe for learning price action and keeping it simple. 1. Set the market landscape with support and resistance. 2. Pick up one trading setup. 3. Learn about positive expectancy and probabilistic mindset. To speed up your learning, refer to our expanding guide to price action trading. 3.4. Trade in simulation. Trading in simulation mode is an essential step to day trading futures using price action. With a demo account from your broker, you can do so easily without incurring any costs. Trading simulation has many benefits. It allows you to learn how to operate the trading charting platform, accumulate your trading experience, verify your trading edge, and preserve your precious trading capital during the learning phase. Some traders criticize trading simulation as a wasted exercise as it does not train the psychology of the trader. It is true that a trader's emotions are magnified when real money is on the line. But it does not mean that simulated trading offers no value. Traders who find simulated trading useless are not approaching it with a serious mindset. They treat trading simulation as an aimless game. Try setting a concrete goal for your trading simulation. For instance, you must get a certain amount of profit over a set of simulated trades before you can trade live. Once you have that goal in mind, you will care more about your fake trades. You will get emotionally involved, and your psychological practice starts. 3.5. Start day trading futures using price action for real. Once you are confident of your trading edge in demo, switch to live trading. Congratulations, you are no longer a beginner. If you intend to day trade futures full-time, make sure you perform these extra checks. 4. 10 price action bar patterns you must know. Bar patterns are nifty short-term patterns that are useful for timing trades and finding logical stop-loss points. No price action trader can do without learning about bar patterns. And these are 10 bars patterns that you must know. Reversal bar patterns. 1. Reversal bar. 2. Key reversal bar. 3. Exhaustion bar. 4. Pinocchio bar. 5. 2-bar reversal. 6. 3-bar reversal. 7. 3-bar pullback. Volatility bar patterns. 1. Inside bar. 2. Outside bar. 3. NR7. Learn more. Price Action Trading Resource Guide. 4.1. Reversal bar pattern. What does it look like? A bullish reversal bar pattern goes below the low of the previous bar before closing higher. A bearish reversal bar pattern goes above the high of the previous bar before closing lower. What does it mean? For the bullish pattern, the market found support below the low of the previous bar. Not only that, the support was strong enough to push the bar to close higher than the previous bar. This is the first sign of a possible bullish reversal. For the bearish pattern, the market met resistance above the high of the previous bar. Furthermore, the resistance was strong enough to cause the current bar to close lower. How do we trade it? 1. Buy above the bullish reversal bar in an uptrend. 2. Sell below the bearish reversal bar in a downtrend. 4.2. Key reversal bar. What does it look like? A key reversal bar is a specific instance of a reversal bar that shows clearer signs of a reversal. A bullish key reversal bar opens below the low of the previous bar and closes above its high. A bearish key reversal bar opens above the high of the previous bar and closes below its low. By definition, key reversal bars open with a price gap. As price gaps within intraday timeframes are rare, most key reversal bars are found in the daily and above timeframes. What does it mean? A down gap is a powerful down thrust. When the markets reject such a strong bearish move with certainty, it might have reversed its sentiment to bullish. On the other hand, when a gap upwards bumps into clear resistance, the market might have turned bearish. Essentially, a key reversal bar is a violent display of strength that hints at a change of market sentiment. How do we trade it? 1. Buy above a bullish key reversal bar. If uncertain, wait for price to close above it before buying. 2. Sell below a bearish key reversal bar. If uncertain, wait for price to close below it before selling. 4.3. Exhaustion bar. What does it look like? A bullish exhaustion bar opens with a gap down. Then, it works its way up to close near its top. A bearish exhaustion bar opens with a gap up before moving down to close as a bearish bar. In both cases, the gap remains unfilled. In addition, high volume should occur with the exhaustion bar. What does it mean? Its name explains it all. It represents exhaustion and a failed last-ditch attempt. After the bears are exhausted, the bulls will take over and the market will rise. After the bulls are exhausted, the bears will take the market down. How do we trade it? 1. Buy above a bullish exhaustion bar. 2. Sell below a bearish exhaustion bar. 4.4. Pinocchio bar, pin bar. What does it look like? It looks like the nose of Pinocchio. It has a long and obvious tail. For bullish pin bars, the lower tail take up most of the bar. For bearish pin bars, it is the upper tail that dominates. What does it mean? Paraphrasing Martin Pring, the pin bar lies like Pinocchio. With its long tail, a pin bar breaks a support or resistance momentarily to trick traders into entering the wrong direction. These traders are trapped, and there is always money to be made when you find trap traders. How do we trade it? 1. Buy above a bullish pin bar that is rejected from support level. 2. Sell below a bearish pin bar that is rejected from a resistance level. 4.5. 2-bar reversal. What does it look like? The 2-bar reversal pattern is made up of 2 strong bars closing in opposite direction. The bullish variant consists of a strong bearish bar followed by a bullish bar. Reverse the order to get its bearish counterpart. What does it mean? Every reversal pattern works on the same premise. A clear rejection of a down thrust is a bullish reversal, and a clear rejection of an up thrust is a bearish reversal. In this case, the first bar represents the first thrust, and the second bar represents its rejection. How do we trade it? 1. For bullish reversals, buy above the highest point of the 2 bars pattern. 2. For bearish reversals, sell below the lowest point of the 2 bars pattern. 4.6. 3-bar reversal. What does it look like? In sequence, the 3 bars of the bullish pattern are 1. A bearish bar. 2. A bar has a lower high and lower low. 3. A bullish bar with a higher low and closes above the high of the second bar. Accordingly, the bearish pattern is made up of 1. A bullish bar. 2. A bar has a higher high and higher low. 3. A bearish bar with a lower high and closes below the low of the second bar. What does it mean? A 3-bar reversal pattern shows a turning point. Compared to the other reversal patterns, the 3-bar reversal pattern is the most conservative one as it extends over 3 bars, using the third bar to confirm that the market has changed its direction. How do we trade it? 1. Buy above the last bar of the bullish pattern. 2. Sell below the last bar of the bearish pattern. Read. Adapting the 3-bar reversal for day trading. 4.7. 3-bar pullback. What does it look like? This bar pattern is easy to identify. 3 consecutive bearish bars form a bullish pullback pattern, and 3 consecutive bullish bars form a bearish pullback pattern. What does it mean? When the market is trending, it is difficult to sustain a counter-trend pullback. Hence, after a pullback of 3 bars, the trend is ready to resume. How do we trade it? 1. Within a bull trend, wait for 3 consecutive bearish bars. Then, buy above the next bullish bar. 2. Within a bear trend, wait for 3 consecutive bullish bars. Then, sell below the next bearish bar. Read. Improving the 3-bar pullback. 4.8. Inside bar. What does it look like? An inside bar must stay completely within the range of the bar immediately before it. In other words, the second bar must have a lower high and a higher low. What does it mean? An inside bar is a momentary contraction in price range, volatility. Within the same unit time, the market covers less ground and stays completely within the range of the previous bar. It is a pause in price action and does not show clear strength in either direction. How do we trade it? 1. Place bracket orders around it to trade its breakout in either direction. A buy stop order above its high, and a sell stop order below its low. Once one order is triggered, cancel the other. 2. Place only one order, buy or sell, according to the market trend. 3. Wait for a breakout of the inside bar and trade its failure. Read. A twist on the inside bar. 4.9. Outside bar. What does it look like? An outside bar pattern is the polar opposite of an inside bar. Its range must exceed that of the previous bar with a higher high and a lower low. What does it mean? It is a short-term expansion in price range, volatility. It shows strength in both directions. In most cases, it is uncertain if the bulls or the bears have won. The only certainty is increased volatility. How do we trade it? 1. Wait for a breakout of the outside bar and fade it. Especially for outside bars that look like dojis or those that go against the trend. 2. Trade its breakout, especially when the outside bar closes near its top or bottom. E.g. popgun pattern. 4.10. NR7. What does it look like? This bar pattern requires 7 bars. If the last bar has the smallest bar range within the sequence, it is a NR7 pattern. To clarify, bar range refers to the difference between the high and the low of a bar. What does it mean? Like the inside bar, it indicates decreasing volatility. As the lower volatility comes within the context of 7 bars, instead of a single bar like in the case of an inside bar, the NR7 pattern is a stronger sign of decreasing volatility. However, while the inside bar shows no strength in either directions, the NR7 pattern might drift upwards or downwards. In such cases, the NR7 represents a price thrust with decreasing volatility. As the market alternates between range contraction and range expansion, the NR7 alerts us to stand by for explosive moves. How do we trade it? 1. Buy breakout of the high of the last bar if the trend is up. 2. Sell breakout of the low of the last bar if the trend is down. Read NR7 Trading Strategy. 4.11. What's next? Hybrid patterns. These 10 patterns are not mutually exclusive. In fact, there are many combinations that produces effective bar patterns. Here are some examples. ID NR4 combines an inside bar with a variant of NR7. Reversal bar after a 3-bar pullback. 2-bar reversal with an inside bar as the second bar. Beyond bar patterns. Bar patterns alone will not offer a trading edge. Common strategies incorporate market bias analysis, volume analysis, and trading indicators into the mix. Bar patterns form just one facet of a price-based trading approach. Learn how to use bar patterns as part of a comprehensive trading strategy. 5. 10 price action candlestick patterns you must know. Are you using candlestick charts as your default chart type for price action analysis? Most likely, the answer is yes. In that case, why not make the most out of it by mastering candlestick patterns? According to Thomas Bulkowski's Encyclopedia of Candlestick Charts, there are 103 candlestick patterns, including both bullish and bearish versions. While the encyclopedia is great for reference, there is no need to memorize the 929-page compendium. Simply learn these 10 candlestick patterns for an illuminating foundation. Basic sentiment candlesticks. 1. Doji. 2. Marubozu. Reversal candlestick patterns. 1. Harami. 2. Engulfing. 3. Piercing line or dark cloud cover. 4. Hammer or hanging man. 5. Inverted hammer or shooting star. 6. Morning star or evening star. 7. 3 white soldiers or 3 black crows. 8. Hakaki. 5.1. Doji. What does it look like? It looks like a cross, with the same opening and closing prices. What does it mean? Simple. In a doji candlestick, price is essentially unchanged. Hence, it represents market indecision. How do we trade it? 1. Trade it like a reversal signal, if there is a trend to reverse. 2. Treat it as a signal to stand aside, if there is no trend to reverse. Read. Combining a doji pattern with floor pivots for intraday reversals. 5.2. Marubozu. What does it look like? A Marubozu is the polar opposite of a doji. Its opening price and closing price are at the extreme ends of the candlestick. Visually, it is a block. What does it mean? A Marubozu that closes higher signifies powerful bullish strength, while one that closes lower shows extreme bearishness. How do we trade it? The Marubozu is more useful as a learning tool than as a pattern for trading. Together with the doji candlestick, they highlight the extremes of the candlestick spectrum. By placing a candlestick on this spectrum, we are able to judge the directional strength of any bar. If you must trade the Marubozu pattern, consider the following. 1. Continuation pattern in a strong breakout aligned with the market bias. 2. Part of another candlestick pattern, discussed below. 5.3. Harami candlestick. What does it look like? Just remember that harami means pregnant in Old Japanese. The first candlestick is the mother, and the second candlestick is the baby. Focus on their bodies. The body of the baby bar must be entirely within the body of the mother bar. Typically, in a bullish harami, the first bar closes lower than it opens while the second bar closes higher. Similarly, in a bearish harami, the first bar closes higher than it opens while the second bar closes lower. What does it mean? It means that the market has come to a muted reversal. The candle body stands for the real price change of the candle regardless of its intra-candle excursions. Hence, it represents the real and conclusive movement of the candlestick. The smaller candle bodies points to decreased volatility. Thus, it is not surprising that many harami candlestick patterns are also inside bars. Compared with the engulfing candlestick pattern below, it is a weaker reversal pattern. How do we trade it? 1. In a bull trend, use the bullish harami to pinpoint the end of bearish retracement. 2. In a bear trend, use the bearish harami to pinpoint the end of bullish retracement. 5.4. Engulfing candlestick. What does it look like? Simply flip a harami pattern horizontally and you will get an engulfing pattern. The body of the second candle completely engulfs the body of the first. What does it mean? Again, the focus on the candle bodies looks for real reversal. In this case, the second candle body fully engulfs the first and represents a strong reversal signal. How do we trade it? 1. In a bull trend, buy above the bullish engulfing pattern for bullish continuation. 2. In a bear trend, sell below the bearish engulfing pattern for bearish continuation. 5.5. Piercing line, dark cloud cover. What does it look like? The piercing line and the dark cloud cover refer to the bullish and bearish variants of the same two-bar pattern. The first candlestick of the piercing line pattern is bearish. The second candlestick opens below the low of the first candlestick and closes above the midpoint of the first candlestick. As for the dark cloud cover pattern, the first candlestick is bullish. The second candlestick opens above the high of the first candlestick and closes below the midpoint of the first candlestick. Due to the first criterion of both patterns, the second bar must open with a gap away from the close of the first bar. Hence, these candlestick patterns are unusual in intraday timeframes where gaps are uncommon. What does it mean? It means some traders are sorely disappointed. In the piercing line pattern, the second bar opened with a gap down, giving an initial hope of a strong bearish follow-through. However, not only did the bearishness fail to materialize, it proceeded to erase more than half of the bearish gains from the first bar. This bullish shock offers a great long trade. Likewise, in the dark cloud cover pattern, the first gap up prompted hope from the bulls before the lower close crushed it. How do we trade it? 1. Find major bullish reversals with the piercing line pattern, preferably after a break of a bear trend line. 2. Find major bearish reversals with dark cloud cover pattern, preferably after a break of a bear trend line. 5.6. Hammer, hanging man candlesticks. Let's get this straight. Both the hammer and the hanging man patterns look exactly the same. Both have a candle body near the top of the candlestick and a long lower shadow, around twice of the candle body. Color of the candle body does not matter. The difference is this. The hammer pattern is found after a market decline and is a bullish signal. However, the hanging man appears as an ill omen at the end of a bull run and is a bearish signal. What does it mean? The hammer pattern traps traders who sold in the lower region of the candlestick, forcing them to cover their shorts. As a result, they produce buying pressure for this bullish pattern. Its bar pattern equivalent is the bullish pin bar. The hanging man pattern is a seemingly bullish candlestick at the top of an upwards trend. Infected by its optimism, traders buy into the market confidently. Hence, when the market falls later, it jerks these buyers out of their long positions. This also explains why it is better to wait for bearish confirmation before going short based on the hanging man pattern. How do we trade it? 1. In a downtrend, buy above the hammer pattern for a reversal play. You can also trade the hammer pattern like a bullish pin bar. 2. In an uptrend, sell below the hanging man pattern for a reversal play after bearish confirmation. 5.7. Inverted hammer and shooting star candlesticks. What does it look like? Simply invert the hammer pattern. The inverted hammer is visually identical to the shooting star pattern. The difference is in where you find them. An inverted hammer is found at the end of a downtrend while a shooting star is found at the end of an uptrend. What does it mean? The inverted hammer is a bullish pattern. In a downtrend, the inverted hammer pattern emboldens the sellers. Hence, when the inverted hammer fails to push the market down, the bullish reaction is violent. The bearish shooting star pattern implies a different logic. The shooting star traps buyers who bought in its higher range, forcing them to sell off their long positions and hence creating selling pressure. Its bar pattern equivalent is the bearish pin bar. How do we trade it? 1. In a downtrend, buy above the inverted hammer pattern for a reversal play after bullish confirmation. 2. In an uptrend, sell below the shooting star pattern for a reversal play. You can also trade it like a bearish pin bar. 5.8. Morning star and evening star. What does it look like? Both star patterns are 3-bar patterns. In candle speak, a star refers to a candlestick with a small body that does not overlap with the preceding candle body. Since the candle bodies do not overlap, forming a star will always involve a gap. Thus, it is uncommon to find morning stars and evening stars in intraday charts. A morning star comprises, in sequence, 1. A long bearish candlestick. 2. A star below it, either bullish or bearish. 3. A bullish candlestick that closes within the body of the first candlestick. An evening star comprises, in sequence, 1. A long bullish candlestick. 2. A star above it, either bullish or bearish. 3. A bearish candlestick that closes within the body of the first candlestick. This pattern is similar to the 3-bar reversal. What does it mean? The first candlestick in the morning star pattern shows the bears in control. The star hints at a transition to a bullish market. Finally, the strength of the last candlestick confirms the bullishness. The evening star expresses the same logic. The first candlestick shows the bulls in control. Uncertainty sets in with the star candle. The last candlestick confirms the bearishness. How do we trade it? We apply both patterns to catch reversals as well as continuations. 1. Buy above the last bar of the morning star formation. 2. Sell below the last bar of the evening star formation. 5.9. 3 white soldiers and 3 black crows. What does it look like? Each of the 3 candlesticks in the 3 white soldiers should open within the previous candle body and close near its high. Each of the 3 candlesticks in the 3 black crows should open within the previous candle body and close near its low. What does it mean? In the 3 white soldiers pattern, each bar opens within the body of the previous candlestick and suggests a potential fall. However, each bar ends up with a strong and high close. After 3 instances, the bullishness is undeniable. In the 3 black crows pattern, each bar opens within the body of the previous candlestick, suggesting bullishness. However, as each bar closes lower, the bearishness is clear. How do we trade it? These patterns are effective for trading reversals. 1. Buy above the 3 white soldiers after a substantial market decline. 2. Sell below the 3 black crows after a substantial market rise. Read. Trading with mountains, rivers, soldiers, and crows. 5.10. Hakaki. Despite having a Japanese name, The Hikaki is not one of the classic candlestick patterns. However, it is an interesting pattern that illustrates the concept of trap traders. What does it look like? To find a Hikaki pattern, first look for an inside bar. For a bullish Hikaki, the candlestick after the inside bar must have a lower low and a lower high to signify a bearish breakout of the inside bar. When this bearish breakout fails, we get a long Hikaki setup. For a bearish Hikaki, the next candlestick must have a higher high and higher low. When this bullish breakout of the inside bar fails, the market forms a short Hikaki setup. If you need help looking for the Hikaki pattern, download our free price action pattern indicator. What does it mean? The Hikaki pattern pinpoints the failure of inside bar traders. Trading the breakout of inside bars is a popular strategy. When the breakout fails, we expect the price to blaze in the other direction. How do we trade it? We use Hikaki for continuation trades. 1. Buy if a downside breakout of an inside bar fails within 3 bars. 2. Sell if an upside breakout of an inside bar fails within 3 bars. Read. Detailed review of the Hikaki pattern. 5.11. What's next? Learn more candlestick patterns. Of course, you should not limit yourself to the 10 candlestick patterns above. However, you should familiarize yourself with one pattern before moving to the next. Trying to look out for dozens of patterns without knowing what they are trying to tell you lands you in a confusing mess. Start with Steve Nissen's Japanese candlestick charting techniques, which is the closest you can get to the source of candlestick patterns without picking up a Far Eastern language with 3 scripts. Compare with bar patterns. Despite differences in nomenclature, bar patterns and candlestick patterns are not mutually exclusive. In fact, integrating both will greatly improve your price action analysis. Read. 10 bar patterns you must know. In particular, you would find that candlestick patterns brought along with it a deep focus on analyzing the candle body. The comparison of the candle body, the range between the open and close, which is largely ignored by bar patterns, adds great value to price action analysis. The pairings below will get you started on studying the similarities and differences between bar patterns and candlestick patterns. Harami, inside bar, engulfing, outside bar, hammer, shooting star, pin bar, piercing line, dark cloud cover, 2-bar reversal, morning star, evening star, 3-bar reversal, 3 white soldiers, 3 black crows, 3-bar pullback. Study candlestick trading strategies. Note that we based the trading methods above on our own experience. They might not correspond strictly to Steve Nissen's book. While you can refer to books and other online resources on candlestick patterns for a start, the best conclusion is always based your own observation and testing. Get started with candlestick trading with the strategies below. Engulfing candlestick with market structure, candlesticks with RSI, candlesticks with moving average. 6. 10 chart patterns for price action trading. Do you look at price charts for your trading? But what do you see? These are 10 chart patterns that every price action trader should see when they look at a price chart. Reversal chart patterns. 1. Head and shoulders. 2. Double top and double bottom. 3. Triple top and triple bottom. 4. Rounding top and rounding bottom. 5. Island reversal. Continuation chart patterns. 6. Rectangle. 7. Wedge. 8. Triangle. 9. Flag. 10. Cup and handle. Reversal chart patterns. The first 5 chart patterns are reversal patterns. Typically, they start by trying to continue the trend. When that last-ditch attempt fails, the reversal is confirmed. However, remember that most reversal patterns fail, especially when the trend is strong. Hence, trade them carefully. 6.1. Head and shoulders. What does a head and shoulders pattern look like? The bullish pattern has 3 swing lows. The middle swing low is the lowest. The line connecting the 2 swing highs is the neckline. The bearish pattern has 3 swing highs. The middle swing high is the highest. The line connecting the 2 swing lows is the neckline. What does a head and shoulders pattern mean? In the bullish instance, the left shoulder and the head highlight the downwards trend. The right shoulder, by ending above the head, halts the bearish trend. The break of the neckline then confirms a change of trend. Hence, the head and shoulders pattern is a reversal chart pattern. The same logic works for the bearish pattern as well. How do we trade a head and shoulders pattern? As it is a reversal chart pattern, we need an existing trend to reverse. A bullish pattern must take place in a downwards trend, and a bearish pattern should take place in an upwards trend. Generally, the longer the trend, the larger the head and shoulders formation needed to reverse it. For a bullish pattern, buy on breakout above the neckline, or on pullback to the neckline after the breakout. For a bearish pattern, sell on breakout below the neckline, or on pullback to the neckline after the breakout. Volume should increase on breakout. For the target objective, measure the distance between the neckline and the head. Then, project the distance from the breakout point. 6.2. Double top, double bottom. What does a double top and bottom pattern look like? A double bottom has two swing lows at around the same price level. The swing high in between them projects a resistance line. A double top has two swing highs at around the same price level. The swing low in between them projects a support line. What does a double top and bottom pattern mean? In a double bottom, the first swing low marks the extreme low of a downwards trend. When the second swing low fails to push below it, it is a warning that a reversal might occur. Once the market breaks above the resistance level, it confirms the bullish reversal. In a double top, the same logic applies and leads to a bearish reversal. How do we trade a double top and bottom pattern? As it is a reversal chart pattern like the head and shoulders, we must have a trend for the pattern to reverse. Do not look for reversal patterns like the double top and bottom in a sideways market. For a bullish pattern, buy on breakout above the resistance line, or on pullback to the resistance line, now acting as support after the breakout. For a bearish pattern, sell on breakout below the support line, or on pullback to the support line, now acting as resistance after the breakout. Volume should increase as price breaks out of the resistance and support line. To get the target objective, measure the height of the pattern and project it from the breakout point. 6.3. Triple top and triple bottom. What does a triple top bottom pattern look like? If you can find a double top bottom, looking for a triple top bottom is straightforward. A triple bottom has three swing lows at around the same price level, and a triple top has three swing highs at around the same price level. You can also relate it to the head and shoulders chart pattern. Just that in this case, the middle pivot is equal to the other two pivots. What does a triple top bottom pattern mean? The triple bottom represents two failed attempts to push below the support established by the first swing low. Naturally, it hints at a trend reversal. A breakout above the resistance line confirms the reversal. Similarly, the triple top shows two unsuccessful tries to continue an upwards trend and signifies a bearish reversal. How do we trade a triple top bottom pattern? The trading method is akin to the double top bottom chart pattern. For a triple bottom chart pattern, buy on breakout above the resistance line, or on pullback to the resistance line, now acting as support after the breakout. However, drawing the resistance line of a triple bottom might be tricky, especially if the two swing highs are unequal. In that case, you can draw the resistance line with the higher swing high, or with the second swing high, or somewhere in the middle of the two swing highs. For a triple top chart pattern, sell on breakout below the support line, or on pullback to the support line, now acting as resistance after the breakout. You can draw the support line of a triple top pattern with the lower swing low, or with the second swing low, or somewhere in the middle of the two swing lows. Volume should increase when price breaks out of the resistance support line. It should also decrease with each upswing in the case of a triple top. For a triple bottom, volume should decrease with each downswing. For the target objective, measure the height of the pattern and project it from the breakout point. Read. Trading candlesticks with triple tops, bottoms. 6.4. Rounding top and rounding bottom. What does a rounding top and bottom pattern look like? A rounding top consists of minor price swings that rise and fall gradually, presenting a dome shape at the top of the chart. Flip a rounding top vertically, and it becomes a rounding bottom. Rounding tops bottoms usually take a long time to form and are found more often on weekly charts. What does a rounding top bottom pattern mean? A rounding top shows a gradual change of market sentiment from bullish to bearish. A rounding bottom implies a sentiment change from bearish to bullish. This reversal formation is relatively subdued. How do we trade a rounding top bottom pattern? For a rounding bottom chart pattern, buy when price closes above the high of the pattern. For a rounding top chart pattern, sell when price closes below the low of the pattern. You can take a more aggressive entry by looking for short-term price patterns before the completion of the pattern, especially if the volume pattern is encouraging. Volume should decrease towards the middle of the pattern and rises again towards the end of it. For the target objective, measure the height of the pattern and project it from the breakout point. 6.5. Island reversal. What does an island reversal pattern look like? An island reversal is a piece of price action that is completely broken off from the rest of the chart. It has a gap before it, exhaustion gap, and a gap after it, breakaway gap. A bullish island reversal starts with a down gap in a bear trend. After a period of sideways trading, the market gaps upwards to reverse the bearish trend. A bearish island reversal starts with an upwards gap, followed by sideways trading before reversing the trend with a downwards gap. In both cases, the two gaps must have overlapping price range. What does an island reversal pattern mean? The first gap represents a climatic move aligned with the existing trend. However, instead of following through with the gap's momentum, the market meanders. Hence, when the market makes a gap against the trend, it is a reversal signal. The logic behind this chart pattern is similar to the morning star and evening star candlestick patterns. How do we trade an island reversal pattern? For a bullish pattern, buy when price gaps up away from the island. For a bearish pattern, sell when price gaps down away from the island. For this chart pattern, volume should decrease for the first gap and increase with the second gap that is reversing the trend. For the target objective, measure the height of the island and project it from the breakaway point. Continuation chart patterns. As price retraces in a trending market, it forms a variety of continuation chart patterns. To find these chart patterns, simply draw two lines to contain the retracing price action. Draw one line above the retracement, resistance, and one line below it, support. As you will see below, the relationship between these two lines will help us differentiate the continuation chart patterns. 6.6. Rectangle. What does a rectangle pattern look like? If two horizontal lines surround a retracement, it is a rectangle chart pattern. Both the bullish and bearish rectangle patterns looks the same. However, they appear in different trend context. What does a rectangle pattern mean? A rectangle chart pattern indicates sideways action. When the market enters in a congestion phase, it is likely to break out in the direction of the preceding trend. How do we trade a rectangle pattern? Remember that the trend before the rectangle chart pattern determines if the pattern is bullish or bearish. A rectangle pattern continues the prior trend. For a bullish pattern, buy on breakout above the resistance line, or on pullback to the resistance line, now acting as support after the breakout. For a bearish pattern, sell on breakout below the support line, or on pullback to the support line, now acting as resistance after the breakout. Volume should increase when price breaks out of the resistance and support line. For the target objective, measure the height of the rectangle and project it from the breakout point. 6.7. Wedge. What does a wedge pattern look like? For a wedge pattern pullback, the two lines converge. A bullish wedge chart pattern takes place in an upwards trend and the lines slope down. It is also known as a falling wedge. A bearish wedge chart pattern is found in a downwards trend and the lines slope up. Rising wedge. What does a wedge pattern mean? The defining feature of a wedge chart pattern is the set of converging trend lines. It means that the magnitude of the swings within the wedge pattern is decreasing. This contraction in swing magnitude implies that the wedge is moving against the path of least resistance. Hence, when the market moves decisively with the trend, it confirms that the trend is resuming. How do we trade a wedge pattern? For a bullish pattern, buy when price breaks above the resistance. For a bearish pattern, sell when price breaks below the support. Volume should decrease as the wedge pattern forms and increase with the breakout. For the target objective, measure the height of the entire wedge pattern and project it from the breakout point. 6.8. Triangle. What does a triangle pattern look like? There are three types of triangle chart patterns: ascending, descending, symmetrical. We can describe each variant easily with the two trend lines surrounding the retracement. An ascending triangle has a horizontal resistance and a rising support. Example on the right. A descending triangle has a falling resistance and a horizontal support. Example below. A symmetrical triangle has a rising support and falling resistance. The support line and the resistance line should slope at similar angles to produce the symmetry. Example on Investopedia. What does a triangle pattern mean? An ascending triangle pattern is a bullish chart pattern. It shows the market in a pause during an upwards trend. However, the rising swing lows imply bullishness. By the same logic, a descending triangle pattern, with the lower swing highs, is a bearish pattern. The symmetrical triangle is a continuation pattern as well. However, its directional tendency is less obvious. It depends on the trend in which it forms. Thus, it is bullish when it forms in a bull trend and bearish in a downwards trend. How do we trade a triangle pattern? In a bull trend, buy on breakout above an ascending triangle or a symmetrical triangle. In a bear trend, sell on breakout below a descending triangle or a symmetrical triangle. Volume should decrease as the triangle chart pattern forms and increase with the breakout. For the target objective, measure the height of the widest part of the triangle and project it from the breakout point. 6.9. Flag. What does a flag pattern look like? A flag pattern has a flagpole and a flag. The flagpole is a sharp thrust in the direction of the trend. Identifying the flagpole is critical for the flag pattern. Look for strong and obvious price thrusts with consecutive bars, gaps, and strong volume in the same direction. For a bullish flag pattern, we need an up thrust as the flagpole. The flag is made up of two parallel lines that slope downwards. The bearish flag pattern has a down thrust as the flagpole. The two lines making up the flag are also parallel, but slope upwards. A related chart pattern is the pennant pattern, which is essentially a flagpole with a triangle pattern as the flag. What does a flag pattern mean? The key feature of a flag pattern is the flagpole, which is a powerful price move. The flag pattern represents a short break before the market continues moving in the same direction. Hence, it is an ideal continuation chart pattern. How do we trade a flag pattern? Buy on breakout above a bullish flag pattern. Sell on breakout below a bearish flag pattern. Volume should decrease as the flag pattern forms and increase with the breakout. The target projection for a flag pattern is different from the other chart patterns. Measure the height of the flagpole. Then, extend it from the lowest point of a bullish flag or the highest point of a bearish flag. 6.10. Cup and handle. What does a cup and handle pattern look like? The cup looks like a rounding bottom. The handle, which follows the cup, looks like a typical retracement, for e.g. wedge, flag. The cup and handle chart pattern is a bullish pattern. Its bearish counterpart is the inverted cup and handle pattern. What does a cup and handle pattern mean? A cup and handle pattern is basically a rounding bottom following by a pullback. Hence, it marks a period of consolidation in which the bulls take over from the bears gradually. The last retracement, handle, is the last bearish push. When it fails, we expect the market to rise. An inverted cup and handle pattern follows a similar logic with a rounding top and a pullback upwards. How do we trade a cup and handle pattern? The conservative entry for the cup and handle chart pattern is to buy on breakout of the high of the cup. The aggressive entry can take place once the handle pullback fails. For the inverted cup and handle pattern, you can sell when the market breaks below the low of the cup or when the handle pullback breaks down. The volume pattern should resemble that of a round top-bottom for both the cup and the handle formations. For the target objective, measure the depth of the cup and project it from its high or low for the inverted pattern. To learn more about trading with the cup and handle pattern, refer to How to Make Money in Stocks, a Winning System in Good Times and Bad, 4th edition. 6.11. What next? Understand that chart patterns fail. Trading examples of chart patterns, including those above and on other websites and books, are usually textbook examples. The purpose is to show the ideal form of chart patterns working effectively. This is why the target objectives seem magically achieved each time. However, like any other trading methods, chart patterns fail. To get a realistic idea of the success rate of chart patterns, there is no better resource than Thomas Bulkowski's Encyclopedia of Chart Patterns. It has extensive performance statistics and ranking of most chart patterns. Learn to interpret chart patterns. Thomas Bulkowski's research uses rigid definitions of chart patterns which are reasonable for his purpose. However, in fact, most traders differ in the way they find chart patterns as they look at price swings, degree of swing, and draw trend lines, ignore or include candle shadows, differently. This is not a problem because trading chart patterns is, in any case, beyond simple pattern recognition. Using chart patterns in isolation is not a winning strategy. Instead, include volume, short-term price patterns, and other support/resistance tools to pinpoint trading opportunities. While the target projection of chart patterns is a valuable tool for target setting, combine the projected target with other support/resistance levels for better results. With experience, you will also realize that the simplistic classification of the patterns into reversal and continuation does not always apply. The trading rules of each chart pattern are more like guidelines. If you love chart patterns, I recommend these books: Technical Analysis and Stock Market Profits by Richard Schabacker, Technical Analysis of Stock Trends by Edwards, McGee, and Bossetti. To complete your price pattern education, don't miss 10 bar patterns you must know, 10 candlestick patterns you must know. 7. Price action trading strategies, beyond price patterns. Most price action trading strategies revolve around price action patterns like pin bar, inside bar, and engulfing pattern. As a result, many traders equate price action trading strategies with price action patterns. The truth is that price action patterns merely form a subset of price action trading strategies. For instance, a pin bar is simply a price pattern. A pin bar trading strategy must define the market condition for trading pin bars, the entry setup, and the exit method. Buying and selling every pin bar you see is a recipe for disaster. Price action trading strategies go beyond price patterns. A price action trading strategy must answer the following questions. How do we determine the market bias? What is our trading setup? How do we exit the trade? In this article, we will explore each question to find out what is it that really makes price action trading strategies tick. Hint: it is not the price patterns. 7.1. Market bias, price action context. Market bias refers to the market's tendency to move in a certain direction, either up and down. It is also known as the market trend or price action context. The market bias is what gives us our edge. It has a strong influence on the success of our trades, far more than any 1, 2, or 3 bar price pattern. To prove this point, we will look at how different patterns do within a given market context. We marked out the ID/NR4 patterns on the S chart below. We also observed how pin bars performed in this market. This last chart marks out the 2 bar reversals. For all 3 patterns, most of the bearish signals did well, and most of the bullish patterns failed. The last chart is extremely telling. Usually, traders would look out for 2 bar reversals that have strong bars in both directions or for the second bar to reverse the first bar completely. However, for our example, we did not impose any more criteria to enhance the pattern. We simply marked all 2 bar combinations with opposing direction, i.e. a bullish bar followed by a bearish bar, or a bearish bar followed by a bullish bar. As it turned out, this simple pattern did extremely well. The merit does not lie with the pattern. It lies with the bearish market bias. The point here is that once we get the market bias right, almost any pattern will produce results. There might be some whipsaws, but they are not fatal as long as our trade risk is under control. Hence, we should spend more time figuring out the market bias instead of searching constantly for price patterns. However, this is easier said than done. We selected the bullish market above by looking back in time. Anyone can do that. The difficult part is in evaluating the market bias in real time. In price action trading strategies, there are several simple but effective tools to help us decipher the market bias. Multiple time frames. Some price action trading strategies pay attention to price action in a higher time frame as a way to find the bias in a lower time frame. Market structure. The market never moves in a straight line. It moves in wave-like market swings, creating swing highs and lows. Most price action trading strategies are sensitive to the market structure built by these swing pivot points. Higher highs and higher lows point up. Lower highs and lower lows point down. Read. Trading engulfing candlestick pattern with market structure. Trend lines. Upward sloping trend lines track bullish markets, and downward sloping trend line follow bearish markets. In price action trading strategies, a decisive break of trend lines signals the beginning of a new opposing trend. Our example strategy in a template for a simple day trading strategy uses a trend line to define the market bias. Support and resistance areas. In a bullish market, support levels are likely to hold up. In a bearish market, resistance areas tend to keep the market down. By paying attention to how the market reacts at major support and resistance areas, we can get a glimpse at the true bias of the market. Volume. Many price action trading strategies include volume analysis. Along the path of least resistance, the market should move with increasing volume. On the other hand, when it is moving against the market bias, volume tends to dry up. Hence, when implementing price action trading strategies, traders should use these tools and integrate their observations to find out which direction the market is more likely to head in. This is the first step in all price action trading strategies. The importance of market bias also underlies the rise of global macro trading and trend-following strategies. While the former uses fundamental data and the latter employs technical methods, both strategies seek to align themselves with the market bias, without overemphasizing the exact timing of their entries. 7.2. Price action trading setup. A trading setup is a specific set of market circumstances we want to see before we consider a trade. In price action trading strategies, it involves a price pattern. Examples of short-term price patterns include an inside bar, reversal bar, or any candlestick pattern like engulfing or morning star. Some price action trading setups focus on longer-term chart patterns like head and shoulders and double top. Didn't we just argue that the market bias provides us with the trading edge? Then why can't we just figure out the market bias and jump right into the market? Why do we need a trading setup? In theory, we can simply enter a trading position once we form our opinion on the market bias. Once we change our bias, we exit and reverse the position. However, this way of trading demands deep pockets. This is because the adverse price change between the time we enter and the time we realize that our market bias has changed can be huge. Since retail traders do not have deep pockets, if you do, you are an institutional trader, we need to control our risk with little pockets of money each time. This leads us into the purpose of a trading setup, which is risk control. By timing our entries with a setup, we are able to pinpoint a stop-loss point in our price action trading strategies. This is especially true for price action trading setups which have a natural and logical pattern stop point. This is usually the lowest point of a bullish pattern or the highest point of a bearish pattern. Pattern stop. This chart shows the natural stop-loss level of a bearish pin bar pattern. Too many price patterns to learn? Start with our guide to reading price action. 7.3. Trade exit plan. There are several ways to exit a trade. In price action trading strategies, as mentioned above, our stop loss depends on our entry setup. As for setting targets, There are two common price-based methods. Support and resistance. Support and resistance levels provide logical points for exiting. For a long position, the nearest resistance level is the highest probability target. For a short position, the closest support level is the highest probability target. If we aim for levels that are further away from the market, we need to accept a lower chance of the market hitting our target and some pullbacks along the way. Measured move. What if the market is breaking new ground? It is moving into price ranges that it has not been to recently. In such cases, the measured move concept is useful for projecting targets. The measured move takes the length of a previous impulse swing and project it by the same amount. It is a specific instance of Fibonacci extension using 100% for the projection. Using a smaller percentage gives more conservative targets. For best results, base your projection on a strong and clear impulse wave. 7.4. Creating your own price action trading strategies. Ultimately, trading boils down to finding a method that is suitable for your skills and temperament. Hence, instead of blindly following price action trading strategies of purportedly successful traders, learn from them what makes sense to you. Focus on picking up methods and knowledge that answer the three questions revolving around price action trading strategies. Then, combine them to create complete price action trading strategies that tick for you. Remember that price action trading strategies go way beyond just price patterns. 8. Instantly improve your trading strategy with support and resistance. What is the best way to improve your trading strategy? Use support and resistance concepts in your trading strategy. Learn how to use support and resistance levels in your trading strategy to improve your trading results. 8.1. What are support and resistance levels? Before you learn about support and resistance, you must first understand basic demand and supply. Demand and supply are the underlying forces of price movements. Market turns up when demand overwhelms supply and turns down when supply overcomes demand. Technical analysis studies recurring price patterns that result from demand and supply changes. Fundamental analysis drills into the determinants of demand and supply. Prices move up when demand is stronger than supply. Buyers are more eager to buy than sellers are willing to sell. So buyers will offer a higher price to entice sellers. Price rises. Prices drop when supply is stronger than demand. Sellers are more eager to sell than buyers are willing to buy. In this case, sellers will lower their asking price until buyers are willing to buy. Prices fall. At support levels, we expect demand to overwhelm supply. When demand is stronger than supply, price will rise. Or at least, price will stop falling at the support level. At resistance levels, as supply overcomes demand, we expect the price to stop rising and fall. Take note that support and resistance are not clear-cut price levels. They occur over a range of prices. However, for convenience and clarity, many technical analysts draw lines to mark out support and resistance. Drawing lines to represent support and resistance is acceptable as long as you understand that the lines actually represent zones where the demand and supply imbalance switches. 8.2. How to find support and resistance levels. Swing highs and swing lows. Swing highs and swing lows are earlier market turning points. Hence, they are natural choices for projecting support and resistance levels. Every swing point is a potential support or resistance level. However, for effective trading, focus on major swing highs and lows. Learn. Find powerful anchor zones for high probability trades. Congestion areas. Market participants have spent a prolonged time in congestion areas. It is likely that they have formed psychological attachment or have established actual trading interest within that price range. Hence, earlier market congestion areas are reliable support and resistance levels. Congestion areas reinforces the idea that support and resistance are zones, and not a specific price level. If you need help finding congestion areas, price by volume charts might help. Psychological numbers. Humans attach significance to certain numbers. Round numbers are the best examples. Round numbers always make financial headlines. The natural number trading strategy derives its trading edge from round numbers. The 52-week high and low price of a security is another example of a psychologically important number. Calculated support and resistance. You can also derive support and resistance from calculated values like the moving average. They work best in trending markets. Combining candlestick patterns with a moving average is a reliable trading method that uses moving average as support and resistance. Fibonacci retracement is another popular method for projecting support and resistance by calculation. With a decent charting package, we can mark out retracement levels easily without manual calculation. Identify major market swings and focus on retracement of the move by a Fibonacci ratio. Fibonacci ratios include 23.6%, 38.2%, 50%, 61.8%, and 100%. A 100% retracement is the same as using a swing high and low as resistance and support. The intraday trend trading strategy we reviewed uses Fibonacci retracements to find the best trades. Flipping of support and resistance. Flipping is an important concept for support and resistance. It refers to the phenomenon of support turning into resistance or resistance turning into support. When price breaks through a support level, it shows a shift of power from buyers to sellers. The support level then becomes a resistance level that sellers are confident of defending. The reverse is true for price breaking through resistance. This concept is applicable regardless of the method you use to find support and resistance levels. Support and resistance from higher time frame. To focus on major support and resistance levels, you can find them on higher time frames before applying them to your trading time frame for analysis. For instance, you can note down the support and resistance levels from the weekly chart. Then, plot them on the daily chart to find trading opportunities. This method keeps you focused on important support and resistance levels instead of flooding your chart with dozens of potential support and resistance levels. 8.3. How to use support and resistance levels in your trading strategy. Trading direction. In uptrends, support levels are likely to hold. In downtrends, resistance levels tend to hold. Hence, if you see that support levels are holding up, you might consider taking only long trades. The reverse is true if you see resistance levels holding up. Paying attention to price levels is a simple way to find a clear market bias. This example is from our weekly chart analysis. It shows major swing lows that are holding up as support, which is a sign of a bullish market. Filter bad trades. Your trading strategy might have its own way of determining market bias. In that case, do not confuse your analysis with support and resistance. Rely on your trading strategy for a primary bias. However, you can use support and resistance analysis to augment your trading strategy. For instance, if your trading strategy dictates a buy, but price is right below a major resistance level, you might want to wait for a clear breakout of the resistance before entering on pullbacks. By waiting for more price action to unfold near support and resistance levels, you can avoid low-quality trades. Trade entries. Look for bullish signals at support levels and bearish signals at resistance levels. This is the key to finding the best trades in any trading strategy. This chart shows a trade from the MACD with inside bar trading strategy. The bullish inside bar was a result of support at an area of earlier price congestion. It had the makings of a high-quality trade. Trade exits. Support and resistance, even the minor ones, are effective as price targets and stops. For day traders, the high and low of the previous trading session are important support and resistance levels. This example, retrace day trading setup, shows that the low of the previous session was the perfect price target for this trade. 8.4. Support and resistance, essential and effective. Support and resistance are essential features of the price landscape. Do not navigate prices without them. Before considering any trade, mark out the support and resistance levels. These potential zones of demand and supply will help you understand the market. Use this understanding in your trading strategy to your instant advantage. 9. 4 ways to trade a channel. Do you trade with a channel? There are dozens of channels for trading, including linear regression channel, moving average channel, and trendline channel. Regardless of your favorite channel tool, there are 4 ways to trade them. Let's learn about them to make the most out of your trading channel. 9.1. Trading trends with channels. This is a trend trading strategy. To use this trading method, you must have a channel that is sloping at a healthy angle to confirm that the market is trending. A trendline channel is the perfect tool for this trading method. Let's go through this channel trading example. 1. We drew a trend line with 2 swing highs. The trend line was sloping downwards. 2. Then, we drew a parallel line starting with the swing low to complete the channel. 3. Prices went up to test the trend line, which is also at the level of a previous congestion area. Hence, the context was excellent for a bear trade, so we went short with the bearish inside bar. 4. The channel trend line provided the perfect price target for this trend trade. We could have taken the short trade using only the trend line. However, having the channel gave us a clear exit point for this trade. To learn more about trading trends with trendline channels, read Channel Surfing: Riding the Waves of Channels to Profitable Trading. 9.2. Trading reversals with channels. When price exceeds the channel trend line, it could be a climatic move, implying that the trend has exhausted itself. We can then look out for reversal trades like the one below. Reversal trades are usually low probability trades, so we must select only the best trades. Follow these rules to find the best reversal trades. Ensure that the channel is going against the trend of the higher time frame. Effectively, you are looking for a retracement of a larger, more powerful trend. Trade reversals with steep channels. Steep channels are unsustainable. Strong rejection of breakout of channel trend line. Like the outside bar in the example above. 9.3. Trading ranges with channels. Channels are not just for trending markets. They are also useful in highlighting range-bound trades. In horizontal channels, we can trade without directional bias. We can sell short at the top of the channel and buy at the bottom. The gimme bar trading setup is an example of trading ranges with channels. However, in the gimme bar strategy, the Bollinger Bands acted as the channel. Read our review of the gimme bar trading setup to learn more. 9.4. Trading breakouts with channels. The earlier strategies assume that the channel will contain price action and seek to buy low, sell high. What if this assumption fails? Then, we might have a breakout trading setup that often offers quick profits. However, judging which breakouts are valid is an art that is hard to master. Pay attention to volume. Valid breakouts are strong with increased volume. Look out for breakout bars with above average bar range. Read Yum continuation pattern. For trading strategies that finds breakouts with channels, take a look at Quick Trade using linear regression channel, a classic example of a breakout trade. A simple day trading strategy. It uses MACD to confirm the breakout of Bollinger Bands. 9.5. Make the most out of trading channels. Channels are powerful trading tools that highlight trading opportunities for all 4 types of basic trade setups. However, for some traders, having too much trading options is a drawback. They look for trading setups everywhere. They take a retracement trade, and then a reversal trade, and then think that a breakout is impending. All these within a few minutes. They are overtrading. A solution is to draw a larger channel to analyze the larger price context and only take trades in its direction. For indicator-type channels, you can increase both the look-back period setting and the deviation setting to create a larger channel to contain long-term price action. Let's go channel surfing. 10. How to keep trading records as a discretionary price action trader. Most traders agree that trading records are essential to improving your trading performance. But when it comes to the specific pieces of trading information to record and how to do it, things get fuzzy. Some traders think that the trading records from their brokers are enough. Others might record their reasons for taking each trade. Some might have a trading emotions journal. Some traders even track their physiological responses, like their heart rate and body temperature. To get the right answer, we must look at the goal of keeping trading records. Our aim is to improve our trading results. And we can do this by refining the source of our trading edge, which is determined by our trading style. Here, I will focus on what a discretionary price action trader should record and the right way to do so. Most price action traders trade with discretion. This is also how I trade. This trading style has 2 main components: price action and discretion. 10.1. Recording price action. As price action traders, we find our trading edge from price movement. Thus, to improve our trading performance, we must make price action a cornerstone in our trading records. Move beyond recording basic trade information like the profit, loss, and time of entry, exit. Start recording your price action analysis. I am not referring to the price action reasons behind each trade. For instance, I took this trade because of a pin bar. I am referring to a constant analysis of the market's price action, regardless of whether you are considering a trade. It is almost like a market commentary to yourself. A simple example goes like this. The day opens with a gap down. It is trying to make a bullish push but is rejected by the low of the last session. A bearish pin bar forms, but the top shadow is quite short. I expect the market to fall. The market is falling now. It makes a new low. A reaction should be coming soon. It is an ongoing analysis that encompasses price structure, patterns, and speed. It includes your description of price action as well as your expectations of it. There are two main benefits to recording your analysis of the market in real time. Over time, these trading records will be the basis of your trading rules. For instance, your records show that after several doji-like bars, it is better to abstain from trading. This is a valuable conclusion you can use to improve your trading rules. Also, recording your analysis in real time will help you avoid hindsight bias. This common bias causes traders to overestimate their trading skills. With real-time recording, you will come to terms with your ability to read price action in real time. You will not fall into the trap of looking at historical charts and thinking that you know how to find the perfect trade each time. Anyone can do this. If you have truly mastered the skill of analyzing price action, these real-time analysis records will be the proof. With them, you will gain the confidence to trade in real time. 10.2. Recording discretion in trading. What does being a discretionary trader mean? It means that you do not trade with fully automated trading systems. It also means that your trading rules are not rigid. You bend your rules according to the intuition that you have developed or are trying to develop. The basic conviction is that in your brain, there is something valuable you cannot quantify or reduce to rigid rules. This something is often called the trader's intuition, gut. This fuzzy idea of discretionary trading has an obvious problem. When you exercise your discretion in trading, are you relying on solid intuition? Or are you just using discretion as an excuse for your lack of discipline? Adding a simple step to your record-keeping process will answer this question. For each trade, record if that trade is one that conforms to your trading rules completely, or one that requires you to bend them. The former is a mechanical trade, and the latter is a discretionary trade. Label each trade as mechanical or discretionary before the end of the trade, before you know if the trade is a winner or loser. After collecting a decent sample of trades, labeled as mechanical or discretionary, in your trading records, review their performance. Is your discretion adding value to the rigid rules? Do the discretionary trades do better than the set of mechanical trades? If they are adding to your trading edge, you have well-honed trading skills. If not, you should probably stick to your rules and start working on your trading discipline. 10.3. The critical difference, ex-ante versus ex-post trading records. When keeping trading records, distinguish between ex-ante and ex-post records. In our discussion above, we have emphasized this principle. As humans, we are extremely susceptible to hindsight bias. There is almost no chance of avoiding it when we look at historical charts. Learn technical analysis for one day and you can pick the best trading setup of the decade from a historical chart. It seems so easy. Adhering to this simple principle will keep your trading records accurate, consistent, and useful. Let's see why. Ex-ante record. The market will rise after this bullish reversal pattern. Ex-post record. The market did not rise. This is undeniable proof that our expectation was wrong. Recording everything ex-post will give rise to hindsight bias. If the market did not rise, we would conveniently forget the fact that we expected it to rise. If the market rose, we would congratulate ourselves for being such a good price action trader. It is human nature to want to feel good and forget bad experiences. Our minds distort the truth easily, unless we record it before our minds get the incentive to do so. This is why discretionary traders experience difficulties when they trade in real time. They are either overconfident of their ability or they are unable to trust their own read of the market. In both cases, they are doomed. For such traders, keeping good trading records of their price action analysis in real time is the best solution. Mechanical traders can backtest their trading systems. Also, real-time decisions do not play a role for their style of trading. If you are a discretionary price action trader and you have not been keeping solid trading records, it's time to start. Image credit. Fondos Archivo by Archivo FSP, own work. Licensed under CC by SAW 3.0 via Wikimedia Commons. 11. What's next? Congratulations for mastering the basics of reading price action. Ready to move to the next level? Here are some recommended options. 11.1 How to Trade with Price Action, ebooks. You have just completed the Kickstarter edition of this series. The Strategies edition contains an explanation of 10 price action trading strategies. It includes a variety of price patterns and minimal indicators. The Master edition explains the more advanced concepts in price action trading with a focus on intraday trading. Click here to download the 3-book How to Trade with Price Action series for free, or pay what you want. 11.2 How to Trade with Price Action online. The How to Trade with Price Action ebooks are compilations of selected articles on trading setups review and are updated periodically. For our latest articles on price action trading, visit our website now. 11.3 Day Trading with Price Action Self-Study Course. Interested to learn the complete price action trading framework I use to trade? Take a look at my self-study course. End of this book, please subscribe. Thank you.